Hi, good afternoon and welcome. My name is Rashid Hassan. I'm a faculty in the School of Business here at George Mason University, and I'm an executive in residence at our new center, Business for a Better World. I'm delighted to welcome you all to this session with a group of excellent panelists who will be joining us here. And I'm also delighted to have Derek Horstmeyer as a co-host, my fellow colleague from the School of Business. He is the director of the Financial Planning and Wealth Management program here at the school, and also co-founded and directs the Student Management Investment Fund. He will soon introduce our panelist. I want to say that if you have any question, please use the chat box. We will take as many questions as we can. Before I hand over to Derek, I want to take 2 minutes to introduce our center, the Business for the Better World, and I will basically share some slides with you. Can everybody see my slide? So the center, we believe in, as part of the center, is that a better world is everyone's business. Our vision is to think of the business as a positive force in the world. Business should lead in addressing the pressing problems of the world, not create them. Our approach is to challenge and to partner with businesses and other organizations to tackle issues that transcend sectors and borders. We use United Nations 17 global goals as our North Star. We bring together leaders from every sector, shape business education into a force of positive change, and we prepare tomorrow's leaders to further our common vision. We have fivefold mission. First, to educate the next generation of leaders to address the complex challenges we have, generate knowledge to rethink and reshape business and social norm, convene leaders across all sectors to exchange ideas and to find new ways of solving problems. We aspire to affect change with action-oriented partnership and lead an international movement to reshape business education. We have a couple of signature programs we have launched in 2021 and we will continue in 2021. One is the Impact Fellows and Internship. This is an opportunity for first-generation college student, minority student, immigrant student, and student from a low socioeconomic background to have a 2-year wraparound experience at George Mason University in terms of engaging renowned faculties to teach them, to have individual mentorship, and to expose them to the business world in a way that is very holistic. We bring students from liberal arts background into our summer program to give them education around the business world. We are in the process of building a social incubator to develop employment opportunities and to provide business ownership for community members who are at or below poverty level. We have launched a new coursework at the business school around stakeholder value creation, and also developing a value index, which I hope someday could also complement the ESG and other measurements that are being used in the business world. And we have also launched this 2021 Stakeholder Roundtable series to engage business leaders, our faculty, our students, and the community at large to exchange ideas to further our vision. With that, I want to thank you for joining us, and feel free to contact us, and we'd love to have your input and your guidance as we develop and work at the center. With that, I'm going to let Derek to introduce our panelist. Go ahead, Derek.
Thank you, Rashid. Hi, yes, again, my name is Derek Horstmeyer. Thank you all for joining us. I run our new financial planning and wealth management degree for undergraduates. I also run our student managed investment fund. So if you ever have any questions about those, please do reach out to me. We have some very nice panelists here today. We have Jason Howell, who actually sits as the head of our financial planning wealth management advisory board, runs that. For those students that are listening today that are interested in financial planning and wealth management, please, again, always reach out to either Jason or I. We're always here to assist and grow this new degree program. We have a financial planning and wealth management advisory board there that sits to provide scholarships guidance, internship opportunities, and a lot of other things. So again, if you ever have any questions, please do reach out to either of us. We also have Marcio and Brad, which we'll get to in a second. But I guess we'll just start off. Jason, do you want to say a little bit about your work? And after we do the intros, we'll jump right into the questions.
Okay, yeah, I guess we're both going to do intros, Marcio and I, so that'll be terrific. So my name is Jason Howell. I am a certified financial planner, chartered SRI counselor, professor of finance at American University, and yes, my alma mater right here at George Mason University. I'm also the author of Joy of Financial Planning. In my role as a financial planner, I help the rich get richer. That's what I do. The rich don't get richer because they're rich. The rich get richer because the rich get help. And I'm the help. They hire me to increase their value, period. That's the point. I figure if I can help increase their value, whether it's in the form of investments, protection, increasing the spreading of their families within their values within their families across generations, that's what they wanted me to do. When I started Jason Howell Company a number of years ago, I wanted to democratize financial planning for as much of the world as I could. And I came to find out very early on that I'm in the wealth management business. And so that's very difficult to do. And so that's why I wrote the book, Joy of Financial Planning. That's why I teach. That's why I teach not only here, but at AU and anyone that is willing to listen. And what I came to find is even with the wealthy people I work with, there's an opportunity. Last year, when 2020 happened, I was just as shocked and surprised as everyone, and I wanted to do something great like everyone. And then I thought about my clients and the kind of good people they are and the skills that I have and what I could possibly do. And I found this world of ESG investing, not like it was hiding, as Marcio might tell you. It wasn't hiding from any of us, but I discovered it in a way that I hadn't recognized it before, and got really involved and spoke with people like Marcio and others who are experts in the field. And I was excited and enamored that I not only can make the rich get richer, but I could work with the rich. I could serve my wealthy clients, and we don't have to take from them and give to the poor. We can just serve them, and they freely share their values with people who are needy and who are hopeful and who are looking for greater opportunities. That to me is the most exciting thing about this concept around stakeholder capitalism, as Professor Hassan works with, and the work that he's doing with Business for a Better World. And yes, the kind of investing work that we do as financial advisors, it's fantastic. It's a great opportunity. It's the opportunity we have to change the world working with capitalism, as opposed to thinking it's something different than capitalism. So I look forward to this conversation, and my peers on this panel. I think it's going to be a great one.
Great, thank you, Jason. With that, I'll turn it over to Marcio.
Hello, everyone. It's a pleasure to be here. Thank you, Jason, for the invitation.
You bet.
Thank you, Derek. Thank you, Rashid. It's a pleasure to be here. I live in Arlington, Virginia. I'm a dad of 2 kids, 11 and 6, husband, and very involved with the local community. But I also think of the global community, the world as a whole. I'm originally from Brazil, from Rio de Janeiro. And you may not know, but the forest inside Rio, it was not there all the time. It was a coffee plantation. They had to replant the forest because they're running out of water. So they had a serious environmental disaster in the city, and they had to solve it by replanting the forest. So that was an interesting imprint that you can do something for a better world in future generations. I benefit from the vision of those folks in the middle 1800s who decided to replant the forest. Also in 1992, the first global environmental conference took place in Rio. And I remember watching and seeing this. This created an impact that eventually it came back to my professional activities. I have been an independent advisor for over 10 years. I'm a CFP, Certified Financial Planner Practitioner, CFA charter holder, and I'm a financial advisor with Total Financial Group, in Silver Spring, Maryland, just outside Washington, D.C. We serve a diverse client base, primarily of people with strong progressive values. Right now, we have 2 advisors and 2 support staff, and we're likely to be opening intern and junior positions soon. So if you have students here listening, we'll be hiring. We're passionate about sustainable personal finance. So what is sustainable personal finance? 1, create strong financial plans to enable our clients and families to achieve their dreams and aspirations, and we make the plan happen. 2, we provide sustainable investment solutions that align our clients' money with their values. We understand that how people invest matters, and we all vote with our dollars. Our core values are independence, planning, diversity, and sustainability. In our investment portfolios, we typically have high ESG, environmental, social governance ratings. And we also use mutual fund companies that are committed to sustainability and impact and advocacy. We have been managing money this way for over 20 years. And we believe that great investment results, they are a result of sustainability and independent professional advice. And our clients ask for it. It's about values, about ethics, and also lower the risk, because a sustainable portfolio has been observed to have lower levels of risk. Planning-based advice along the way, always making adjustments. But in fact, in 2020 and 2019, we saw some unusually strong performance of sustainable portfolios relative to the broad market. It may be a trend that will persist. It may not. That is likely to vary year to year, but it's somewhat encouraging. And the United States in the beginning of a massive shift in the way we invest. And this transition has been a lot more advanced in Europe. And perhaps sustainable investing will be something redundant. And everybody will insist in sustainability, and sustainable investing will be just investing. So we here at Total Financial, we are actively working to be meaningful participants in this transition. Thank you.
Thank you, Marcio. That was great. And now for a unique perspective, we have 2 financial planners here and one that is doing actually direct investments in this field. I'll turn it over to Brad Swanson.
Thank you, Derek, and thank you to my colleagues also for the chance to participate in this panel. My name is Brad Swanson. I have a pretty long experience in international finance, and before that, diplomacy. I've worked in more than 60 countries around the world, and for the last 20 years, I've been focused on, as Derek said, actually investing in small companies that have an impact on people's lives in emerging markets. You've probably all heard the term microfinance. This is the bulk of the investments we make are in not the directly loans to the small families, but to the institutions in the emerging countries that make those loans. So we're lending to the lenders, we're making equity investments in those lenders. I actually manage the equity portfolios of the fund manager where I'm a partner. It's called Developing World Markets. Overall, we've put about $2 billion to work in both loans and equity investments in micro and also small business lending in more than 60 countries around the world. The private equity side is fascinating because you're not only having a direct impact on building a balance sheet of a company, you're part of the management, in effect, the governance. You are a partner in helping them to grow. And so we see on a daily basis the kind of risks and the kinds of challenges that are involved in growing a lending company, but also maintaining that focus on ensuring that there are positive benefits both to the client and to the overall development of the economy in the countries in which we serve. Just maybe one quick sentence on COVID, because I'm sure the question in people's minds will be, how has microfinance, how have emerging markets fared during this period of a global pandemic. We can talk more about it if you wish, but the short answer is that much better than I anticipated. I think the reason for that is because the level of activity that we are financing through these microorganizations is very basic economic activity. It's very small scale agriculture, retail trade, building, repairing things. That happens day in and day out. So while the overall economy can go through some very difficult and tumultuous periods, at the bottom of the economy, there's kind of a steady state of economic activity, which is necessary for people's basic human needs to be maintained. And that's the level at which we operate. So certainly we haven't gone through unscathed, but there is an underlying resilience in this activity that I've been very pleased to witness.
Thank you for that. And yeah, thanks for that note on COVID. That's very interesting. So let's just, again, thank you for those introductions, and let's just jump right into the questions because we have quite a number of them. And if anybody listening out there does have any questions, please just put them in chat. Oh, and one other thing I forgot to mention, Brad will be taking over the ESG investing course that we offer in the business school here in the finance department. He'll be taking that over that next spring. So please do look out for that. All right, this one's kind of oriented to Jason and Marcio. How are investor demands changing when it comes to portfolio construction? And I'll do a follow-up question that will pertain to Brad after that.
I'll start, and then we'll have the expert go next. I've admired Marcio for many years. You know, the way people are asking for this now, this kind of investing has only increased over the years. It's only come to a head in some ways because of 2020. But over 80% of all adults are interested in some kind of screen in regards to environmental, social, or governance, and that's the stat. And over 90% of millennials. And so if you think about the adult population, you're talking about just about, you know, everyone over 40, which are the people that are going to be in the investing world, are very interested in this kind of investing. The only question is, how do you do this kind of investing? And different advisors have different levels of understanding about how to do that, different techniques for doing that, different ways of looking at data, or different partners they work with. But nearly every adult wants to do better for the world, and this is one mechanism for them to do that. We've seen this also in institutional investing as well. But Marcio, your comments would be great too.
Yeah, we serve a clientele that tends to be very progressive in their values. And this clientele will be ready to take a hit in investment performance in order to invest more sustainably. They believe it will be the right thing to do, and it'll make them feel better with themselves and what their money is doing. So that was the motivation for years and years, and how we were addressing that investor demand, because some investors really do care. Now, most recently, we have seen a different type of investor, which is an investor that doesn't really have any kind of strong concern per se regarding environmental, social goals. They are interested in better investment performance. They are interested in growing their portfolio in the best possible way. And this is a new wave of some clients reaching out to us, because we have created some reputation around this type of investing sustainability as being something profitable with lower risk, better returns. And it may be a trend, it may be something like a fad. It's not clear to know where the market is, but it's definitely caught the attention of the media. We have CNBC has had a series on sustainable investing. We had in the cover of Kiplinger, and we have the Wall Street Journal. It's all over the place. And so a lot of investors are interested purely for economic reasons without any concerns that go beyond that. But it's our core of our clients, our major niche they care about this no matter what, and they think that that's the right thing to do. And we primarily serve these clients, but if you can get better return along the way, that's awesome. But it's about some core principles.
Yeah, and if I can follow up on that, the United States leads the world on what's called essentially ESG factor type investing, looking at environmental and social governance factors within the SRI model. So what does that actually mean? It doesn't mean screening out bad companies. Whoever says whichever companies are bad, right? Depends on someone's opinion. It doesn't mean that. It means actually taking those factors as another data set and applying it to their current investing strategy. It could be passive, it could be active, it could be fundamental analysis, it could be technical analysis, but then adding more that is brought to us by sustainable and responsible investing to look at risks that maybe are not qualified or quantified in those financial statements. And so I've seen the same with my clients. They're not coming to me wearing Birkenstocks and sitting by the pool and wanting to, just make the world a better place and give peace a chance. They kind of want that like we all do, but these are their investments, for crying out loud. And remember, they said they want to increase value. That's my job for them. What's really exciting about the sophisticated way we can look at this kind of investing is we don't have to do it in a way that discounts performance. We can do that with the same aspiration we have to actually increase performance to the extent that we can. There is no proven singular model for increasing performance 100% of the time. That's just not the case. But this is one of many opportunities to do so, and it just happens to help the planet. It happens to help society.
That's really good points there on that performance versus sacrificing returns. That's always a long-standing debate, and we covered a lot in these classes. When you go back and you look at things all the way back, we have data going back to the 90s where you have things like the KLD index to kind of track these things. And you're right, it kind of does track the S&P and these other indices pretty well, if not beat them. And it's interesting to hear you say that you have a new crop of investors coming up to you and saying, I really don't care too much about, saving the world. I really want to maximize returns. And going into, I'm guessing this are clean tech kind of renewable energy projects that you guys are offering in your portfolio. So that's kind of interesting, really interesting to hear. Brad, I was going to follow up on a similar line of question. Do investors look differently at perceived economic return and social value in the developing world where you're investing and in developing markets?
Yeah, it's a really important dynamic that we work with every day because we have mainly institutional investors who themselves, being insurance companies and pension funds, have got policyholders and retired people they have to deliver benefits to. So they're definitely telling us what you're doing is important in terms of social benefit, but it has to give us risk-adjusted commercial rate returns to justify our allocating our scarce resources, part of our portfolio, to it. And frankly, over time, we've developed a better sense of to what degree and in what sectors these risk-adjusted returns can be delivered. It's not the case that you just throw a lot of money at a small family community business in India, and voila, you have commercial rate returns. It's got to be structured, it's got to be thought through carefully, it's got to be managed in a very professional way. But I think now, after having done this for about 20 years and seen the evolution in the market, I can definitely say that at least in terms of the senior debt returns that an institutional investor can get on a portfolio of loans to a diversified set of microfinance institutions and small business lenders in various parts of the world, I think those returns are equally commensurate with the kind of risk that you are taking on. And I qualify it as kind of equivalent to a low investment grade sort of risk. These microfinance institutions are very stable. I mentioned a moment ago the situation with COVID. That stability is part of their DNA, and so yes, I think we've established that you can get a predictable, commercially valid set of returns for investing in microfinance debt. Now, equity is a slightly different issue there because these are not listed institutions in the main part. These are private companies. So whenever you do a private equity fund, you have to be used to having a lot of volatility, having a lot of uncertainty about the return levels. It's also very difficult, frankly, to qualify your own return as a private equity fund against a benchmark because so much does depend on the vintage, other factors. I won't get into all that. But my bottom line on private equity is that I think we probably in the microfinance world have a little bit of performance lag compared to other private equity sectors in the developing and the developed world. But that's because it's still fairly young. 20 years ago, you had very few microfinance institutions we could even find large enough, professional enough to make, say, a $5 million equity investment in. As that field develops, I'm sure the ability to construct coherent governance strategies that lead to profitable exits for private equity investors is going to develop at the same time.
Okay, great. A follow-up question for anybody here, because you kind of all touched on it. We'll get to the risk idea, which I think is interesting to talk about. But I'm just curious, when clients come to you, approximately what fraction of their portfolio are they looking to allocate to, either in the case of Brad's area, microfinance, portfolios, or in your case, Marcio and Jason, more ESG oriented equities? What kind of fraction of their portfolio are you looking to kind of tailor to those solutions?
I like to jump into that one. Most of our clients are quite committed to this approach, and they would love to see their whole portfolio paying attention to it. And the whole portfolio with high sustainability ratings and the sustainability approach. As a matter of fact, the vast majority of assets under management we have in our portfolios that we work with different clients to accomplish different goals, they are sustainable portfolios, and we have the solutions paying attention to sustainability ratings, and a lot of times provided by mutual fund companies that have a history and being active players in the sustainability world. So our portfolios are sustainable. Everything is sustainable. And we would not differentiate between, okay, this is set aside to be core index-based, and this is the more sustainable type of approach. And then we carve out part of it to pay attention and part of it not to pay attention. What we do, we pay attention the entire portfolio. That's the most common experience.
Yeah, and for us, before we get to clients, I'd sort of say from our firm perspective, Jason Howell Company, we wanted to make a decision about what kind of firm we wanted to be and what kind of leadership we wanted to have in the industry. And so in August of last year, our entire website changed. It went from what might be considered more generic wealth management to being entirely invested in this idea. The hardest part was finding an image that could include all E, S, and G. So you'll see wind turbines at jasonhowell.com. That was the closest I could get. Maybe Marcio, you got some ideas for me. But we took our firm and we went that way. And as I said at the beginning, our clients are coming to us for value increase. And so when we have been working with them on extrinsic value increase, they followed our lead. That's why we are advisors. When we came to them and said, we'd like to include some intrinsic value increase, every single one of them said, yeah, sign me up. And so it isn't a question of allocating some to one area of investing that might be different kind, as Marcio said. Everything that we do is pointed towards getting better and better at delivering both the extrinsic value, so performance will be there, that's our gig, but also the intrinsic value of what they want to basically be a part of as stakeholders of the community.
In our case, it's somewhat different because you have to understand that when an institutional investor goes to allocate assets, we fall into the alternative bucket because we're not providing listed products, we're not providing liquid products. And so within that alternatives bucket, you'll find all the bits and pieces of that don't fit neatly into other major asset classes. So we feel we're very happy, and we're getting a very small sliver of a very large global investment portfolio, because even with those very small pieces, the world we're looking at, mainly microfinance, is now estimated at about $150 billion market, which is probably 10 times the size it was when I started 20 years ago in this. And the reason is that because we have been able to show that commercial level returns are feasible, we've segued from a mainly charitable, mainly foundations, mainly endowments, social value first, return second outlook, to a mainly commercial outlook where investors actually can look at microfinance as an alternative asset and compare risk and return transparently with other alternatives.
Great, great. We're getting a lot of questions in chat. Hopefully I get to these. Wow, okay, we already have a lot of questions.
Jump to them, they're pretty good.
Yeah, okay. Here's one from Ethan, who's actually a student of mine, going to Marcio. You mentioned that companies with better ESG scores are seen to have less risk. What is your response to some critics of ESG investing who say that risk reduction is not due to companies doing good, but rather by not being bad?
Great question, and I tend to agree with this assessment. It's not necessarily what they do, and not necessarily what they don't do. Is a lot is just the industry they're in, and there are industries that are considered cleaner industry than others, and these industries, they by nature have higher ESG ratings. So if you're in the business of mining coal, you're probably not going to get great ESG ratings. And if you're in the business of using a lot of fossil fuels in your supply chain, the same. So the reality is that we may be living through a transition, and the transition is a world where people wouldn't care about those impacts to a world that most people do care about it. And there can be some heavy-handed regulations that will make some business not viable. And if you have assets that you cannot transform into cash, the value of these assets will eventually be much lower than what they were in the past. So if you have stranded assets, that's a problem. If you have some headline risk, that's a problem. If you have a lot of potential shareholders not willing to buy your stock because you don't perform well in society, that is also a problem and increases the risk. So ESG would be a way to mitigate some of these risks, not necessarily by what they do, but what they don't do, and basically what they are. So it's very different than the impact world. This is just a rating mechanism, and based on some metrics, they try to be objective. And here's my assessment on the long term, the big picture here. The data to assess the ESG risk is not settled. We don't have clear standards. We don't have clear accounting standards. We don't have clear methodologies to really assess what kind of risk is there. There's some tentative ways of addressing it, but it's far from being settled. And this creates a bit of an opportunity, because if the investing public, if investors realize that this is actually a risk factor that is going down, that will justify eventually high prices. But this is not yet known by the market as a whole, by market participants as a whole. And it starts to play out. As it gets more and more settled, there's some sort of tailwind in terms of valuation of lower risk, higher prices, and then a process of repricing these types of companies, these price of assets. And this could mean a period of some outperformance for this type of invest via a lower level of risk that's now being assessed, that's now being known as the standards become more widespread, as this risk becomes better understood. And then this creates better long-term performance. This is a thesis maybe for the academics to verify and double check, but I kind of had that hunch that that could be playing out.
Okay, I like it. Yeah, that is definitely an really interesting thesis for the two academics here to check out. Any follow-ups on the risk idea? What risk is this contributing to or reducing in a particular portfolio? I'll let Brad or Jason go.
I'll just say a couple things, and I'd love to hear Brad's ideas too. You know, the first thing to think of as we step back here, there's short-termism versus long-termism. So we know corporations report their financials every quarter, every 3 months, and analysts watch that. And by watching that, they make assessments about whether that stock is going to go up or down. Okay, let's just be really easy about this. And so what do you do if you're a public company? You do everything you can to make those numbers look great every 3 months in the short term. Dell Computer at one point went private because they were sick of that. They've since gone back public, but they went private because they were just tired of it. What the risk that we're trying to mitigate with this kind of investing, this sustainable, look at the word, sustainable and responsible investing, is to say in the long term, we are betting on this firm being a going concern, competitive in the market for as long as the eye can see. That's an accounting thing. I learned that right here at George Mason University. For-profit institutions are designed to be a going concern. They're designed to outlive their executive management. And so when you ask the question about risk, and maybe in a quarter or two, you're not seeing the numbers you'd like, that's not the point. It's never, ever been the point. The point is to make your company a going concern. And so you work to reduce that risk in any way that you can. So sure, there's climate risk that's not being priced in, but it is being priced in now for insurance companies. Oh, you bet it is, because that's their exact business. It's a big deal if there's a flood in the community and you're an insurance provider. It's a big deal if there's a typhoon in Japan and you're an insurance provider. So they are pricing in risk. That is happening, and that is very material. Any kind of risk that is material is the kind of risk that folks who use an ESG factoring type of analysis are looking at. It was the kind of risk that that same index you mentioned looked at when they kicked out Equifax out of their index. And then a year later, there was the breach. Was it because they were dumping in the rivers? No. Was it because they were being mean-spirited? They weren't wearing Birkenstocks? No. It's because they scored a 0 out of 10 on cybersecurity. What's that? That's not in the financials, but that is assessed in ESG. That's the G portion. And a year later, we got that huge breach and their stock dropped. I think my clients would have wanted to know that ahead of time, regardless of whether they believed in green energy. And that's what we're talking about when we're talking about ESG.
Very good. Brad, I was going to follow up with you on the risk thing. Is this obviously you have a very unique in the microfinance field, but is this reducing some sort of risk, or is there a risk that investors need to be aware about by your particular field?
Let me step back a minute, Derek and everybody, because I think that what we're talking about here is really two different ways of looking at an investment. One way is in terms of risk, in terms of accepting or not accepting or dealing with or mitigating the risks that you inherently run in operating a certain kind of business in a certain kind of environment, a country, whatever your risks are. But the other way of looking at it is increasing the social returns that come about through your business as a going concern, as Jason said, as a business which has to deliver the kinds of returns that can keep the momentum going forward. But I see a distinction between managing and mitigating those risks that you will be inherently prone to by reason of deciding to manufacture or sell whatever service you do, and a policy and a governance that actually wants to focus on not only managing these risks, but then within this business that you're managing, focusing on increasing the quantum of social return that you can get. So in microfinance, we're definitely much more on that second part of it, but that's because we can be. Because when we're looking at the risks that we're running in the small scale lending businesses that we're doing, our companies that we lend to are not big polluters. They don't have the same kinds of, they're not really contributing that much to greenhouse gases. It's a much easier, I think, from our standpoint as practitioners, to develop the focus on that second part of it. How do we do what we do in such a way that we're not only collecting on the loans we make, but we're making people's lives better, and we're lending to the right kinds of people for the right kinds of activity. But I think that kind of perspective, that bifurcation, is an interesting way of looking at the whole question of ESG. Is it more about saying, well, we have climate change now, obviously it exists. How do we structure our business to be able to deal with that? And this is not a versus, but what maybe in addition, how do we then do what we do to not only manage within the risks we have, but try to increase that level of social value that is producible through the business we do.
Very good, very good. Yeah, I see that distinction. I got a really interesting, almost like a philosophical question that came in at the very top from Libby Jacobson, which I think is interesting and it touches on all of these. So she's curious, what do you say to if a client comes to you who thinks it's just better to make all the money they can in the stock market, and doesn't matter what the company is doing, but then take that money and that returns, which let's say hypothetically is greater. We know that that's maybe not true, but let's just, for the sake of this argument, let's just say you can make more money just by putting it in the stock market and then donating to charity later in life.
I've heard that argument. I certainly have heard that argument. My first question is, what are you trying to invest in? Because that's a part of it. When we talk about, risk, the first rule, Warren Buffett's a pretty rich guy. He says, rule number 1, don't lose any money. Rule number 2, remember rule number 1, right? And so if you're asking me to invest in a company that is prone to failure, then you probably don't want me as your advisor, and you wouldn't want anyone as your advisor to fail. I'm not looking at companies and saying this company is out because they're in oil. For example, Chevron is doing a great job, better than Exxon and others in their peers in regards to trending towards carbon neutrality. So out of the group, they'd be maybe a firm to look at amongst others. That's the reality when you're looking at ESG investing. You're not just screening out. That's what most people think it is, but that's one of 5 mechanisms that you can use to do your analysis. Most of the analysis around ESG analysis, the kind of analysis that CFAs like Marcio do, chartered financial analysts, of which there are just under 200,000 in the world right now, and about 200,000 take the test every year. What they are studying as potential institutional investors is how to look at investment opportunities and mitigate everything that could go wrong with it. Not for being nice, but because they want performance. And so any client that comes to me and wants performance, I'm going to help them understand how I assess performance, and they'll have an opportunity to judge whether, my assessment is good or smart, or whether it isn't. And that would have been the case a few years ago when I was more of a generic financial advisor. If I didn't have an investment philosophy that made sense and resonated with my clients, then they would have every right to walk away.
I would like to add to Jason's comments that looking at ESG factors enrich the investment process and make investing better. But let's assume, for sake of an intellectual exercise, that in fact, when you pay attention to these factors, you'll actually create a drag in your portfolio. And if you just invest in the index, you would do better. Under this assumption, there's a potential that this would work out well if the charity you donate in the end actually does some significant impact and does very good. Because we know very well that there are charities and charities. Some charities, they don't do that good for the world. Some charities are more like self-serving than anything. And you need to have a mechanism to select the charity and to be very effective and impactful in picking that charity. And so the assumption that the ESG consideration actually creates a drag, and when you do the charity selection, you will be able to find a very impactful charity. If that holds, okay, that there's an intellectual case for it, but I don't really think this is the real world. The real world is that you enrich the process and you can make better investing, taking account of ESG. And then, fair enough, if you can grow your portfolio to a point that you can donate later on in life, a similar analysis, and there are solutions for this, and we could have a conversation about how to be as effective as you can in your charitable giving. It's a way to deploy the assets for the greater good later on in life, but it's not necessarily contradictory.
Okay. Thank you. Thank you. That was very good. And we're getting, I mean, there's too many questions to get to, so I want to make an offer to anybody that is writing. Please reach out to me, Jason, Marcio, or anyone. That you have some really great questions here on metrics, ISS versus Glass Lewis, Morningstar, Moody's, getting into the really nitty gritty of, but yeah, please reach out. I'm sure they all have their favorite metrics that they use. But I wanted to ask a kind of a more general question to everybody here. And that is there any developments within your particular specialty that is happening right now that you're excited about? Any particular products that are coming online or demands from your investors that you're really thinking that's interesting and novel?
The most interesting thing to me is what's happening in our government. We have many challenges with this kind of investing. Marcio mentioned a couple of them. There is no standard. What do you do about that? When there was no standard in accounting, what did we have? Generally accepted accounting principles. And so now we, as financial advisors, can look at these financials and more or less kind of figure out where they are. They still do some tricky stuff, but we have some baseline. Of course, there are international accounting standards that the US doesn't follow, but more or less we can reconcile the two. With this new administration, with the new ethos, there is a push to go into this area more extensively. The current nominee for the chair of the SEC, Gary Gensler, is being held up in large part because that's going to be part of his interests. But with new standards, we'll have an opportunity to evaluate. Now, it's not about having different requirements for companies and the activities that they do. At least that isn't the case when I think about it. When I think about it, it's revealing data, so requiring disclosure of data, and then putting together some kind of generally accepted principles, as we have with the PRI, with the UN, the principles of responsible investing. Is that right, Marcio? Maybe adopting those principles or the latter. So it's exciting to me that there's an opportunity now for the United States to help lead the way. We are the largest economy. If we can get some standards, then we'll have a great opportunity to solve some of these other open questions within our community.
I think from my standpoint, what is probably one of the most promising developments is actually something that's making our lives a little more difficult, which is that investors are becoming more demanding now. Initially, when we started this fund, it was enough to say, well, here's the woman and the cow in rural India, and aren't you convinced that this is good for her and her family? And they would take a pretty picture and put it in their annual report. But now we're actually taken more seriously, which is the right way to be taken. The industry is large enough that some institutional investors are putting in significant amounts of money. They start to make a difference in terms of the overall allocations and the returns on the portfolio. And so we are being held to a more rigorous standard of not just the investment protocols, but also the measurement of the social value that we claim to be getting from the investments that we're doing. And in that regard, I'm very interested in, Jason mentioned a moment ago, the PRI. We're signatories to that. We're probably signatories to a half a dozen other kinds of standards out there, which all are dealing with this issue. Ultimately, I hope that we can get to a more standard, more transparent and commonly accepted means of measuring and assessing and comparing these values. Because right now, it's a very complex and sort of disordered world out there when you're trying to measure the social value that you're getting, which is inherently a very hard thing to measure anyway. But I'm very glad to see that as fund managers in the sector, which is promising social value, we're being held more to account now by our investors. That's the right way to go.
I believe that we are making some good progress in creating the standards. As Jason said, what the United States government does moves the needle, and it's very relevant. So that's encouraging. Hopefully we'll see some positive developments there. We have the Sustainability Accounting Standards Board, SASB, and other entities, PRI and others. We're gonna get there. It's a process, but I'm excited we're gonna get there. We have also analytical firms that are committed to this and generating data for the industry, have Sustainalytics that feeds into Morningstar and some other tools. So we'll eventually get there. But what I'm really excited in when it comes to sustainable investing are developments in the fixed income side of things, not just the equity side of things. So we see the availability for retail investors to have exposure to community development bonds that help invest in affordable housing. We also have the growth of green bonds. And we have interesting solutions that you just not need to focus on the equity side, the stock market side, but also the fixed income side, and create impact there. So I'm excited with that. And we're going to have a couple of webinars coming up. April is Earth Month with Earth Day. So our firm will have webinars in April 14 and April 28. We'll be talking about this. We'll touch the fixed income side of things, and we touch also tropical forests. That's my background. So if you want to learn more about these topics, I encourage you to check our website, Toller Financial Group, and we can go from there. But it's exciting to see what happens in fixed income.
Great. Thank you. And thank you for the plug. We are getting a number of questions. I'm trying to get up to all of these. We do have a number of questions on, since there are a number of these questions on what is the best data provider kind of in this space that is analyzing what is sustainability, what is E, what is S, what is G. I just wanted to jump in and see if anyone had a preferred preference over what is the best kind of data provider on the spectrum.
I put some answers in the chat on that.
Okay.
You may not have seen it. So I put rating systems, and there are a number of them, and there is no best one. That's the problem. But Bloomberg, Morningstar, Corporate Knights, International Shareholder Services, you've never heard of some of these, MSCI, Rep Risk, Sustainalytics, which is connected to Morningstar, Thomson Reuters, some of these firms you've heard of before. You've heard of Bloomberg before. They're doing a lot of work in this space. And so, when people say out loud or in chat or on a Zoominar that there's nothing interesting about this space, that it's brand new, that there's just some data about tech companies and everyone's going for that, I tell them I was with you a year ago, that I get it. But if you actually commit to this space and learn what is there, you'll note that there's been a lot happening, not only for centuries, back when it was called socially responsible investing, but there's been a lot happening in the past 50 years. And so I invite all of you to actually, use the Google and do some searches and see who's in the space. That's what I did. I spoke with vendors. I spoke with financial advisors like Marcio and his colleague Fran Toller over at that great firm. And they put me on a path learning some things that I just didn't know before. And this is an opportunity. This should be a start, this webinar, but please continue your education. You'll find some pretty great work is being done, and there's a lot of great work to be done. We could use you, so please join.
Thank you for that. And I'm going to offer one final question because we're running out. We have just about 5 minutes left. One final question to each of the participants. Since we do have a lot of students here listening in, what would be the one suggestion that you would give students to kind of break into this field? So any kind of words of advice along those lines.
Well, I don't mind starting. what we see in our company is that most of the people we hire come from a very solid finance background, often a Wall Street background or some other. And they found after a relatively short time in that world that yes, doing deals is fun. Finance is an exciting place to be. They want something more than the satisfaction of doing a good deal. And so that is for the kind of business that we're involved in, which is it's investment banking, it's fund management, but it has a social aspect to it. It's very important that if you are trying to structure your career out of into a finance with the social value component, that you make sure you don't ignore that finance part. Having that real hardcore experience and understanding how the numbers work and how the projections are put together is something that we really can't do without. So the social motivation and desire to help humanity is equally important, but I think you've got to come with those finance skills.
Mm-hmm, mm-hmm.
Yeah, I was a little disappointed. So I told you at the beginning, and it's part of me helping promote it, the Chartered SRI Counselor. There are less than 500 people who have it. The designation is only 2 years old. People like Fran Toller could probably write the exam. But the reality is, I'll tell you why I was shocked. I got in there and there was all this extra finance stuff that Brad's talking about, covariance and, the difference between, there's like 3 of them that sound the same. And I was like, oh my gosh, I already studied this for the CFP exam. Why are you making me learn this again? Trainer ratio, Sharpe ratio, all this stuff again, because you can't do analysis unless you have that bedrock of finance. And so I agree entirely with Brad. Get an education formally, and then you'll be able to add some value to the conversation.
I would suggest looking at the readings for the TFA exam. There are some specific readings on sustainable investing there. Even if you don't sit for the exam itself, you can find the readings and read about the specific topic. So this is a way to learn more. Also, the U.S. Sustainable Investment Forum, the U.S. SIF, has a course for investors. You can sign up for it, just U.S. SIF. It's a great source of getting informed. And if you want to see big picture in a very holistic way, I would suggest check out the new book by Bill Gates on how to create, a more how to avoid climate disaster from Bill Gates. It's a great book, and you see the big picture of things for somebody who can think deeply and is quite influential. So these are some ideas to learn more.
Great. Thank you, 3. I know there's a lot of questions. There's more questions coming into chat. We didn't have time to get to these, but feel free to reach out to any of the participants, I'm sure, over email or LinkedIn, and I'm sure they'll
nice
answer
book, Jose.
any specific questions there. With that, thank you to the 3 participants, and I will turn it back over to Professor Hassan.
Yeah, thank you so much to our panelists, Jason, Marcio, and Brad, in educating us and sharing your thoughts, and to all the students and the participants for joining in. I would say that, there's so many questions that are there that are aspirational, that is challenging the way we look at the world, even the way we measure it. So I think we as a faculty are obviously trying to explore perhaps what are the better ways to evaluate companies, not just pure cash flow, right? How do we bring something intangible? So I think this has been very inspiring to all of us, and thank you for joining in, and please stay tuned to other activities we'll be doing in the future. And we'd like to see you participate actively and also ask you challenging questions. So thank you all. Take care.
Take care, everyone.
Thanks, everyone.
Thanks.
Thanks for joining, students, especially mine.